Hi everyone, welcome to our channel where we help your real estate investments work harder for you. I'm Samantha from Elevate Realty in Toronto. In this video, I'm going to talk about how you go about picking the best investment property out of a bunch of choices available. Real estate investments are often called rental properties, so you might have a misconception to only focus on rent. But there's actually a lot more to it, like differences in purchase price, operating costs, mortgage requirements, and appreciation, and all of these affect how much you take home in the end. If you want to know which property can actually give you the best returns, you'll have to dig a bit deeper. So I'll walk you through the key factors to consider and what you need to do to choose the best investment property. If you're just starting out with real estate investing, this is important, so make sure you watch until the end. And without further ado, let's get started. All right, let's break returns into 4 parts. The obvious one is cash flow, and this is the net amount you get from renting out your investment property. And don't get this confused with rent, which doesn't take into account the money going out to keep a property running. You get your cash flow number by taking the rent you receive, minus operating expenses and mortgage payments. To help you narrow things down, you should only choose properties that are cash flow positive. This means the property is self-sustaining, so you don't have to stress about putting money into the investment to keep it going. Besides being cash flow positive, here are some other tips that can get you better cash flows. Number 1, bigger properties generally mean better rents. And I'm not just talking about absolute terms, but really as a percentage of the property's value. For example, a $1 million house can get you $65,000 in rent a year. With that $1 million, you can also buy 2 $500,000 condos, but this will only get you $50,000 in rents, so it's definitely not as good. I also recommend buying properties with lower operating expenses, and most of these expenses do vary depending on the size of property, such as utilities, insurance, and property taxes. But condos have a big expense that stick out, and that is condo fees. And this significantly bumps down your cash flows. And when you think about fixed costs like furnace replacements or roof repairs, bigger properties are also more cost effective because that flat fee is split amongst more units. Another thing you deduct from rent are mortgage payments, and these terms really do vary from person to person, and they can also vary depending on what you buy. A typical down payment for a residential property is 20%, but when you buy a commercial property, banks sees this as more risky, and they usually ask for a higher down payment of 35% and also a higher interest rate. All these combined will mean lower cash flows for you. This leads me to the second source of return, which is the equity you gain from paying down your mortgage. When you make those monthly mortgage payments taken from your rent you get, a portion of it goes towards paying down the principal. So as you make more mortgage payments, you'll gain more of the property, which means you don't have to return as much money when you sell it. Typical amortization periods are 25 years or 30 years. If you ask us, we like to go with 30 years just because it's easier to be cash flow positive. On the other hand, if you do go with a shorter period, the returns portion of equity gained will go up. The third source of return is market appreciation. When you hear about real estate prices in the news, this is it. This is calculated as the difference between the price you sell the property and how much it was worth in the beginning. And if you renovated your property, we like to use the appraised value after renovations as a starting point, and you'll see why later. Here's an important note. Market appreciation is not the same for every property. Factors like where you buy, when you buy and sell, and the property type will all make your appreciation a bit different from property to property. And if you want to learn more about how to choose a property that will perform better than market appreciation, check out another video I made that talks just about this. I'll put the link in the description below so you can head there afterwards. The last source of return is forced appreciation, or how much you gain by upgrading a property yourself. So basically, I broke appreciation into 2 parts. Market appreciation, which can't be controlled by you, and forced appreciation, which involves active things you do to a property to increase value. Again, forced depreciation is created because you spent the time and the effort to make the upgrades yourself instead of buying a turnkey property, and this can get you attractive returns over a short period of time. I also wanted to highlight that unlike other returns that keep coming year after year, forced depreciation is a one-time deal. So if you hold a property for a longer period of time, forced depreciation will have less of an impact on your total returns. I also made a video that talks more about these active strategies, so check out the link in the description below to learn more about this. And wait, we're not done. Now that you have a better picture of total returns, you're already better than just looking at rents. But what if you're looking at properties with different price points? Instead of looking just at the absolute returns number, a better metric is to look at returns as a percentage of your total investment. And you can calculate this total investment based on how much money you actually put into the property in the beginning, including your down payments, your legal fees and land transfer taxes, and other upfront investments you use to create your forced depreciation. With all this information, you're ready to calculate the return on investment, or your ROI, which is the number that you can use to help you choose the best opportunity. Once you have all four components of your returns, to get the ROI is relatively simple. You basically just add up all of the returns from the four components, then you take that total and divide it by your investment amount. Now, the higher the ROI on a property, the better the investment. If you're good with Excel, you can create your own spreadsheet to do the math yourself. But if you want an easier way, just use our ROI calculator on our website. And I'll put a link to the calculator in the description below. Here's what the calculator looks like. You'll see that we already have a sample property on here, and you can change up the numbers based on what property you're actually considering. Once you're done, you can scroll down to the bottom and our calculator will spit out the results. Here you can see the total return as an absolute number and a further breakdown by cash flow, equity gained, market appreciation, and forced depreciation. Basically all four numbers we talked about. And you'll also see the most important number, the ROI. There's also some further assurance for you in the Elevates Insights section. And if it's a great property, we'll let you know here. I hope I cleared things up for you so that you can compare properties on a more objective level. By looking at the ROI, you can make a more informed decision and choose an investment property that can give you the best return. Now, please subscribe to our channel if you want to see more real estate investing videos like this one on a weekly basis. And if you need help with real estate investing in Toronto, feel free to reach out. I wish you all the best in your real estate investing journey. Thanks so much for watching, and see you in the next video.